How's it going? Today I'm going to be doing a LBO model walkthrough. I have kind of the prompt up here. It's an Excel sheet. It'll be doing from scratch. It'll be a full three-statement build out. There's a couple of kind of kinks that are thrown in there. So there's a intangible asset step up. There's some management rollover. Um, Pretty basic though. Shouldn't take more than an hour. But I'll do the kind of walkthrough. Try and talk through what I'm doing, what things look like. In terms of my qualifications, none, unemployed, but master StarCraft 2 player, things like that. So yeah, so let's get this underway. First things first, opening up the prompt. Closing date. We see that it's debt-free, cash-free, so we're not going to have any refinancing of debt, which is important. Just kind of have our basic assumptions, operating assumptions, and then our starting balance sheet. So the first thing that I'm going to do, and I actually already did it, is put in an elevator drop. So just like these two, set the column with the two, and that'll be useful for when I'm navigating kind of back and forth or selecting things from the source and uses. Next thing, this will be a typical 5-year build out. Our questions are just going to be what's the MOIC and IRR. So I'm going to put out 5 years of forecast, which is why I did that. Then put in some kind of base formatting here. I like to format my zeros with dashes, but that's just kind of a preference thing. Turn off grid lines because we know what we're talking about. Arial, size 10 font. Says here that the closing date is going to be 2020, so that means we'll be going 2020 plus 1 all the way through 2025. Set this to general. Put in an A for actuals, and then E for estimates. You can kind of pick whatever color you like, but I typically like to do this purple with white. Then we'll put out some base formatting for multiples. So this is just going to be times, like 10 times our EBITDA. Then we're going to have our percentage, which we need positive and negative, 10. And then we'll also have our dollar, which we'll use in a couple of spots. And then lastly, just want to have the kind of hard code input blue. And in case you don't know how to do that, it's going to be Alt-H, FC will be your shortcut. M for more colors, and then the typical one that you'll see people use is this one right here. Just kind of have that memorized as silly as that is. But yeah, so with that kind of out of the way, we'll start working through the prompt, starting with our transaction assumptions. Transaction assumptions. Okay. Format this really quick. Then I'll put an X here so that way I can navigate kind of up and down. But we'll start putting this so our entry multiple, exit multiple. We have our transaction fees, which is going to be our percentage of our TEV. I'll put that in just so it's clear. We have cash to balance sheet. We have our financing fee percentage, and then financing fee amort. Typically, if you're trying to be a little bit quicker doing stuff, like even just like that basic thing that you see right there, copying down the financing fee, placing it with amort years, can be kind of time savers. And there will be a few other spots where you'll see some formatting tricks that'll kind of speed you up, especially if this is under time pressure for a preview interview. Okay, quick sip of the coffee. Now we have our management rollover. Rollover. It says it's percent of equity contribution. Show you how we'll model that. Then we have our intangible asset step up, which is going to be a percent, and that'll be a percentage of our allocable purchase premium. Excuse me, which we'll see. Same thing here. Amort years, and then our last thing is going to be our tax rate. Starting off, we're going to have 10, 10. Transaction fees are going to be 5%. 5 is our cash to balance sheet. 2% is our financing fees. 10% is our amort. For management rollover, it's going to be 10%. And then similarly for our tangible asset step up. And for those of you who don't understand, after you have a transaction, you have the ability to step assets up to their fair value. And so what that's going to allow us to do is take on some additional amortization, and also will create some deferred tax liabilities, which will serve as a benefit during the holding period. We have 10 years for amort step up, and then a 25% tax rate. And so because I have this kind of base formatting pasted in over here, I can just copy this over. So I'll select it, and then I'll select my multiples, and then it'll be Alt-EST, paste over the formatting. Then for the percentages, exact same thing, and then you can press F4. So just to do it one more time to show you what it looks like, and it won't be as much topics or talk about formatting as I keep going, or kind of the shortcuts that I'm doing, but it'll be select that, then select my percentage that I want. It'll be Alt-EST, and then if I scroll down to the next percentage, I can just press F4, and it'll do it just like that. There you go. These all look good. If I was doing good formatting practices, I'd select these all in blue, but typically you should save your formatting until the very end. Next, we're going to have our entry valuation, and Um, so what this will be is your entry multiple times your LTM EBITDA. And so this one doesn't give us the EBITDA. We're going to have to calculate it out. And I think for learning purposes, this can be a little bit difficult. So I'll actually calculate it out really quick instead of plugging it in later, which is what I normally do. So it'll be 250. Gross profit will be this times 0.5. Then we have 10% R&D. So it'll be this times -10. Times -10, -0.1. Then it'll be this times -0.75. So then for EBITDA, it's going to be equal to 81.3. So if we go back in here, we'll type in 81.3. We'll see it when we actually do it. I just think sometimes when you're learning, it's a little bit difficult to have this blank. But typically, what you'll do is if you have a buildup or you don't have the EBITDA given to you, you'll leave this blank. So just leave this. You'll just leave this as a 0. You'll put in your multiple, but then when you're filling everything out, it makes it a little bit more complicated or hard to see for people who are kind of learning. So instead, what I'm going to do is I'm going to pre-calculate the EBITDA, and then we'll go from there. Then we have 10 times. We'll copy the formatting over here. Exactly what I'm doing. Which means that our TEV at close is going to be 813. Then for our leverage, or sorry, financing assumptions, we're going to have first the debt type. Then we'll have our leverage. And so this is where kind of it becomes a preference thing, and depending on what the prompt is asking you for, you're gonna want to include different stuff. So you could have maybe a floor that you want to put in here. You can have maybe a pick rate. You can have kind of a few different things. Here, this is gonna be pretty cookie cutter in terms of what we're gonna lay out. So it'll be our leverage. We'll have a fee percentage. We'll have a fee dollar amount. We'll have our amort years, which were given to us up in the prompt. Then we'll have our amort dollar amount. Then we'll have a rate, and then lastly, we'll have principal amortization. So nothing super fancy about what we're going to be including here. Just kind of really, really basic stuff. So I'll bold this, I'll underline it, we'll do revolver, we have our term loan A, senior notes, and then I'll include PIK debt. And so there's going to be a couple of key considerations, but you can see this thrown in. Remember that for PIK debt, you get to recognize the actual interest on your income statement, but it's a non-cash expense. So instead of actually paying out the interest expense in cash, what happens is the interest is tacked on the beginning balance. So your ending balance or the principal amount grows as you accrue PIK debt. The other thing for this model that's important to note is it's going to be 100% cash sweep with the exception of the PIK. So we're going to assume that any excess cash above kind of the minimum cash balance of 5 is going to be utilized to pay down as much debt as possible. And then we'll also have our totals here. Okay, highlight this, Alt HBC to put in the barrier. So then our revolver, typically you'll see that it'll be undrawn, and we're going to have 50-50, or I'm sorry, 60-40 equity to debt. And so we'll have 6 times of our TEV at close. And so for our leverage, what you do, you just take whatever the leverage amount is, multiply it by your EBITDA, copy this down, select that all, we'll put in our fee, which is 2%, lock that, we can format it as well. And so for the actual fee dollar amount, all it's going to be is however much debt you've raised times that 2%. So here we have 9.8 fees, and then for your amort, it's relatively similar. You just take the number of years and you divide your fee by however much that is. So there we go. We're going to have 1 point. We're going to assume that these are both trading off SOFR plus 400. So this is typically your revolver and your term loan A are going to be floating rate debt. So instead of being like 10%, they fluctuate based off of where SOFR is priced at. And so we'll see that instead of doing a SOFR curve, we're going to have kind of just a basic assumption that SOFR will stay flat at maybe 200 throughout the duration of the period. Then for our senior notes, these are typically like these are higher yield, so we'll assume that this is at 8%. These will be fixed rate, these don't float, and then we'll have 10% PIK rate debt. For our principal amortization, we're going to assume 5% for a term loan. And then just to be good with formatting stuff, I'll format these like this, and then I'll also go like this so everything's lined up. There we go. Now that we have our financing assumptions done, we can do our sources and uses. So there's kind of different preferences, and it depends on how much time you have to do this. You can do really, really basic, just like source, dollar amount type stuff. But typically, if you have time, it can be helpful to look at what the leverage is going to be, and then also what percent of capital contribution it's going to be. I'll bold this. I'll set these all to the right, and I'll copy this over for our uses as well. Okay, here we go. So now that we have kind of all of our key assumptions laid out, we can go through our sources and uses. So the first thing that I like to start with is debt. So I'm going to select out our revolver. I'm going to have our total debt. Put in a border here. We're going to have our sponsor equity, which is going to be our plug. And we're going to have our management rollover. Paste this down. Total equity. And we're going to have total sources. Boom, boom, boom. Select it. Total uses. Okay, we're going to start. We're going to have our enterprise value. Because we're not refinancing debt, we're going to use enterprise value instead of equity value. We're going to have our transaction fees, our cash to balance sheet, and our financing fees. And so typically if you have these all laid out up above, you can just paste them down, set them as values, and then delete out your stuff. Just kind of a little bit of a quicker way to do it than typing it from hand. So we'll have our enterprise value amount, which is going to be this 813. Our transaction fees, which are going to be equal to this 813 times our transaction fee percentage. So that'll leave us with 40. We have cash to balance sheet, which is going to be 5 in this case, and then we also have our financing fees of 9. And so you can also have situations where these are done non-debt-free cash free, and so here you'd have something like debt to refi or something similar where you'd account for that. But here our total uses are going to be 868.4. Divide each capital by or divide each dollar amount of contribution for each use by the overall uses to get us like a percentage of capital. So in this case, and almost always, you'll see that the enterprise value, the actual purchase of a company, is going to be the largest contribution or biggest percentage of uses. To get our leverage, you just take whatever the dollar amount divided by your EBITDA. Take this, sum it, and then we can also format these as such with the X, just to show that it's being times. For our debt, for the actual leverage amount, just paste down whatever it is for a dollar amount. Then for our total sources, they have to be equal to our total uses. So sometimes people build in a check, but it's kind of silly because you're setting it equal to each other. But yeah, I'll break this out. So the key here is that the equity contribution is just going to be the difference between our total sources and whatever other capital we've raised. So in this case, we have total sources that we need a fund of 868 million with total debt of 487. And so our equity contribution is just going to be the difference between our total sources and the total debt. And then for our management rollover, it's going to be this equity contribution times whatever percent the management's going to roll over. So that'll be 38. And then the plug, our sponsor equity, what we're putting in is the private equity company, is just going to be the total equity less whatever management's rolling over. So now we have our sources and uses laid out. We'll look at the capital exact same way. Whatever the dollar amount is divided by the whatever the dollar amount is divided by the total sources. We'll add these two together. Then we can format them as a percent. Like I said, this is kind of a more cleaner way to format, but it does take a lot more time instead of doing just the dollar amount. So if you're under a time crunch, typically you'll leave out stuff like this because you're really prioritizing just getting a functioning model up and running. But because I have the time and it's supposed to be educational, we're going to include everything or format it correctly. Boom. Make sure that our total sources and uses are equal to each other. 10.7 times for both, which looks correct. There we go. Okay. Now, because this is a slightly more complicated model, we need to calculate our goodwill. So we'll have our goodwill calculation, which is going to be our TEV. We're going to take away our debt plus our cash to get us to our equity value, our EQV. Then we take away the book value of equity. We add our existing goodwill. This gets us to our allocable purchase premium. We're going to less the intangible asset step up. Tangible asset step up. And then we're going to add back in any DTLs that are created. And that'll get us our pro forma goodwill. And because we haven't made necessarily balance sheet adjustments or kind of laid it out yet, there's going to be a lot that's missing here, but we'll just come back in after we've adjusted the balance sheet correctly. So, or after we've laid out the initial balance sheets, we'll highlight this in yellow for stuff that we still need to do. I'll do alt equals for a quick sum, paste that in, and then also typically I'll lay out kind of on the side intangible asset step up, intangible asset step up, just like that, bold, underline, italicize, and then I'll have the step up amount, step up, I'll have the amort, I'll have the DTLs that are created, and then I'll have the DTL unwind. And depending on how your stuff is kind of situated, you can do it differently, but I think just doing it off the side is best. I'll just do it like that. Perfect. And so I know that my step up amount is going to be equal to this allocable purchase premium, so mouthful, times my intangible asset step up. So we'll do it like that. My amort is just going to be the step up amount divided by however many years it's being amortized over. So in this case, it'll be 10 times. And I'm going to lock this here so that way I can paste this down for the DTL. So it'll be the DTL divided by that. And then for the creation of the DTL, it's just going to be the step up amount times the tax rate. So it'll just be like that. And now I can kind of link everything in. So just to be clear, the amort is just the step up divided by the amort years. The DTL unwind is just the DTL divided by however many amort years are going to be. Now I can link in the step up, link in the creation of the DTL, and then we'll come back to fill out everything else once we have our balance sheet stuff situated. So now we're on to the income statement. We're going to have our revenue, that's our COGS. What do we have here? We have R&D, SG&A, D&A, CapEx, so pretty standard. So here we'll have our gross profit margin, like this, HB, less our R&D, less our SG&A, which will get us our EBITDA. And so here we're going to be able to back plug in that EBITDA up in our enterprise value calculation like we had earlier. We're going to have less our D&A. We also have to remember to include the amort of our intangible step up. So we'll get us to our EBIT. From here, we're going to have less our cash interest because we have cash and PIK interest. So cash interest expense, less our PIK interest expense. And then also here included is the amortization of our financing fees. And so you might be wondering, if this is amortization, why is it below EBIT as opposed to EBITDA? And so typically the treatment of this is that it's more interest-like, and so you'll include it underneath EBIT as opposed to EBITDA. Really won't have a material impact because either way it's still like going to be affecting before your taxes, but most people, the correct way to kind of do it academically is to include the amortization of financing fees under EBIT. Okay, then we'll have our EBT, paste this down, and lastly we'll have our taxes, less our taxes. That'll us to our net income. Select that out here, boom, Alt HBC, and we'll have our operating assumptions, which were given to us as a part of the prompt. So it'll be I, so it'll be our revenue growth rate, it will be our percent gross profit, percent R&D, percent SG&A, percent D&A, percent CapEx, and then last thing should be our tax rate. So our revenue growth rate, I think I actually forgot to list it out, but it'll be 10%. And then also it's sometimes helpful here when you start actually building out the multi-year thing. So income statement, cash flow statement, balance sheet to lock the top of your screen. So just come up to the top left, do Alt WFF, and that'll keep this top row locked. So you'll be able to see while you're putting in kind of the income statement line items what year you're in, so that way you don't get off base. So revenue growth rate is going to be 10%. Our gross profit margin is going to be 50%. Our R&D is going to be 10%, 7.5% for SG&A, and then 10% for CapEx and D&A. And then we can link back to our tax rate up here, just like that. And so these are going to stay consistent throughout the period. So just do equals the previous and then paste it over. And then you can do the same thing here. Oh, there we go. And then I'll copy the percentage formatting from up here. That's kind of why you have it up at the top. Paste it over. And now we can start putting stuff in. So our revenue, excuse me, our revenue in year one was 250. Our gross profit was 125. So we can just subtract out the difference between our gross profit and our revenue to get to our COGS. Then for revenue, the way you grow this is you do 1 plus the growth rate from the previous period. And once I have these equations in place, I can just paste over. So this is just doing the difference, and this is doing the percentage gross profit times the revenue. So that's a quick way to do that. For our R&D, it'll be times this. If you press F4 twice, it'll lock it, so it'll move left to right, but not up and down. And so what that does is that I can just paste the equation over for SG&A too. So that's nice, especially if you have maybe a third line item in here or something. Just saves you a couple of seconds of doing that. So we'll get us to our EBITDA, which we can link back now of this 813. So I'll go back up here because I know we hard coded it earlier. But this will be equal to our EBITDA over here. There we go. For our D&A, it's going to be the revenue times the percentage. And you can have kind of more complex situations where you're building out a property, plant, equipment schedule, but a lot of the times you'll just see this kind of basic percentage of revenue calculation for DNA. For our intangible asset step up, it's just this amort amount that's up here. Oh, not negative. Boom. So equals. Um, then for our cash and PIK interest, we won't be able to calculate this until we have our debt schedule completely built out. So we'll highlight that in yellow to remember to come back. Amort's going to be $1, like that. And there we go. Now we have everything up until EBT. For our taxes, it's just negative EBT times whatever our tax rate is. And our net income is just going to be the sum between these two things. So there you go. Proper formatting would be include dollars here, which I'll do. But again, if you have time crunch and you're kind of slower, it might make sense to leave things unformatted until the very end. Probably the best way to do it. Next, we have to do our balance sheet. And so for your balance sheet, depending on how complicated the model is, you can have kind of really, really basic like paper stuff that looks something like this stepwise would be like your transaction assumptions, which includes your entry slash entry. You'll have your sources and uses. You'll have free cash flow calc. You'll have your debt schedule, and your returns. And you might not even have this like debt schedule. It might just be like assume bullet payment at maturity, but this is kind of what the base looks like. You can have much more complicated where you'll have, instead of just your debt schedule, you'll have, or instead of just basic free cash flow calculation, you'll have a full three statement build out. So that's what this is. So here, these steps, you'll have income statement, you can have goodwill calc, you can have income statement, what's called IS, a full balance sheet and a full cash flow statement, and then you'll have your debt schedule and then your returns analysis. So that's kind of what we're doing here. But the important thing to note is if you have this balance sheet, you have to reconcile it. So you have to make the necessary changes, including the elimination of existing debt, because we're assuming that it's on cash-free, debt-free basis. You reflect your cash to down to the minimum balance. You have to include the creation of intangibles or asset step-ups if you're stepping up PP&E. You also have to include the new tranches of debt. So you'll have to do kind of this pre-transaction, debits, credits, post-transaction to get your like opening balance sheet at the end of 2020. So that's what we're going to do here. So starting off with our assets, we have cash, we have AR, inventory, prepaid expenses, we have PP&E, we have goodwill, then obviously we'll have the intangibles that we wrote up. Now we go to our total assets. See, paste down this to get our liabilities. So we have AP, accrued liabilities, and existing debt. And there's going to be a couple of line items you have to remember to add here. So accrued liabilities and then our existing debt. Then we are going to have all the new tranches of debt. So go back up to your sources and uses. Typically, you're going to want to pull stuff from your sources and uses instead of anywhere higher after you have it laid out. So you have all our new debt, which you paste it down. Then we're going to have our capitalized financing fees, which are going to be like contra liabilities. So it's going to go down as negative on the balance sheet. And then the last thing we have is the details that we made. So that'll be all of our liabilities, total liabilities, and then the last thing we'll have is our shareholders equity. Also for like highlighting the whole row, this is shift space. And then if you want to highlight a whole column, it's control space. Those are pretty useful things to use as well. Then we'll have our balance check here, which is just going to be equal to our assets less our liabilities plus equity. Paste that over. And so now we can start to paste everything in to do our reconciliation. So starting with our cash, our initial cash balance was 50. We had 20 of AR, 10 of inventory, 10 of prepaid expenses, 100 of PP&E, 20 of goodwill, and then 0 intangibles. And then for our AP, we had 15, 10, 100 of existing debt, obviously 0 of everything else because it wasn't part of the balance sheet. And then our beginning shareholders' equity was 85. Brings us to 210. Okay, so in reconciling this, first we're going to start with cash. We're going to eliminate our existing cash balance because it's cash-free, debt-free. And our new cash balance is going to be kind of this minimum cash balance that gets transferred over. And so debits obviously increase assets, credits decrease them. And so our ending balance or post-transaction kind of opening balance sheet is just going to be the sum of all of this. And I'll paste this equation down because that's going to be true for all of our assets and liabilities. Then for AR, inventory, prepaid expenses, and PP&A, we have no changes. There's no write-up. For our goodwill, we're going to write down the existing goodwill and just put in the pro forma balance as our new one. Our intangibles are going to be equal to, I'm putting in a negative here to flip the sign, this write-up from up above. Put this in. Then for our existing debt, we're going to write it down. No change to AP or accrued liabilities. For our revolver and all of our debt balances, we're just going to credit these in line with the actual dollar amount. So that'll come from up here. There we go. For our capitalized financing fees, like I said, I think I pasted a bunch of many. This is going to be equal to negative whatever the number is because it's contra, so it'll be negative 9.8. And then for our DTLs, it'll just be equal to the DTLs that we created up here. So back to this. Paste over the formula for total liabilities. Make sure it's including everything. Perfect. For our shareholders' equity, the one thing we need to keep in mind is that we have to subtract out the transaction fees, and we also have to eliminate any existing equity. So it's just going to be negative existing equity less whatever your transaction fees are, and then you're going to credit this in line with whatever the new equity is. So in this case, it'll just be this number down here, 308, the total new equity. And we'll paste down this. So when we look at this, you're going to see that right now it doesn't balance. That's okay. The reason it's not balancing is because we haven't reflected the necessary changes for a goodwill calculation. So we'll go back up. Now that we know what our debt balances was, so I think it was negative 100, so we'll do equals our negative debt. For our cash, we'll do equals whatever our pre-transaction cash balance was. The book value of equity is going to be equal to this negative 85, with our existing goodwill being, I think it was 20. So we're just linking everything in. And now that we've done that, what should happen is that our closing balance sheet is now situated. So you'll see that it balances, and so we can paste it over to our ending of 2022. So do this, paste Control C, Control V, Control C, Control V, Control C, paste it down for all the liabilities, paste over the calculation for total liabilities, make sure that's right. Oh, and we'll select it one more time. And there we go. Now we have our closing balance sheet. So we made the necessary adjustments. That's kind of what this section was. This section was just adjustments. Okay. So now we can start looking at how we're going to forecast the balance sheet items. So typically you'll use DSO and DPA assumptions. Just kind of just your balance sheet assumptions. And so this will be for all your working capital items. We'll start with inventory, or I'm sorry, we'll start with receivables, inventory, prepaid expenses, and then on the liability side, it'll be accounts payable and accrued liabilities. So for our AR, we'll start by taking this. And so what you're going to do is you're going to calculate what the receivable days were, what your inventory days were for the last year, and you're going to assume that that remains the same moving forward. So we'll start with inventory, and so with this, or start with receivables, and so this will be your receivables divided by your revenue times 365, so 29.2. And we'll just assume that that stays the same moving forward. For inventory, it's a little bit different, but relatively the same. You're going to divide by your COGS instead, because that's the driver, multiply by 365. See that we have the same inventory days as payable days, which is receivable days, which is funny. And then for your prepaid expenses, you're just going to do this as a percentage of revenue. So what you'll see is for line items that don't have a clear driver, your base assumption is just going to be keep it consistent as a percentage of revenue. So that's what we'll do here, 4%. AP is more like COGS, and that we grow it, or it's driven by our COGS. So divided by our COGS times 365. So that stays the same moving forward. And then our accrued liabilities are going to be like those prepaid expenses. It'll just be a percentage of revenue moving forward. Okay, now that we have all of our kind of assumptions laid out, formatted correctly, we can start building out the cash flow, or building out our balance sheet. So the first things first is cash. We're definitely not going to be able to see an inventory in our property, plant, equipment. We won't be able to see until we complete the cash flow statement. So these we're going to have to come back to. For our AR, we're going to kind of back into it using these receivable days. And so what you do is you flip the equation. So when you think about it, I'll write it out after we do this. When you think about it, essentially the way it works is your receivable days are equal to your AR divided by revenue, or divided by your rev times 365. And so you can kind of rework this equation to back into your AR. So your AR is going to be equal to your receivable days divided by format this divided by 365 times your rev. And so this is the equation that we're doing here. Is this receivable days divided by 365 times revenue, essentially just backing into it, assuming that the days are staying the same. So that's what this was. It's, if you look at it, it's your receivable days divided by 365 times your revenue. So we're just kind of backing into these figures. We'll do the same here for inventory, except you have to remember that it's times COGS, and I'm using a negative because you want a positive output. I have my COGS listed as negative, but divided by 365 times your COGS. And you can sense check a lot of this, like, does it make sense that I'm seeing this growth up top? Like, if I saw something where it was like 5 after being 20 initially, I'd be like, all right, I think I mistyped. But for the most part, this looks pretty in line with what it's been. It's growing consistently, and so it looks like that's right. For the ones that are a percentage of revenue, just multiply it by percentage of revenue. There you go. For our goodwill, you're going to assume that that remains unchanged. There's no amortization associated with it. Unless you have an acquisition during the period, it'll just stay the same. For our intangibles, though, we will have the amortization. So we have to make sure that we're including in this $7 of amort every year. Paste out our, just control R forward all these equations. There we go. So we have our assets situated for the most part. Now we can go to liabilities. AP divided by 365 times those COGS. And making it negative just so it's a positive output, just like that. For accrued liabilities, it can be a similar situation. You just have your 4% accrued liabilities multiplied by the revenue. There we go. Our existing debt balance, we've written that off entirely and that won't change. So you can just set it equal to the previous period. For all of our debt items, you're going to have to keep these uncompleted for now, just because you need to complete out the debt schedule to get a sense of what the ending balances are going to be for all of those. Moving on to our capitalized financing fees, these will be amortized by this amount right here. So we just do it like that. Sorry, I have to. Actually, we'll do it correctly. We'll do it this plus, and then we'll link back to our financing assumptions, our amort up here. We're going to lock that because it's going to stay consistent throughout the period. And then for our DTLs, it's going to be our beginning DTLs less this kind of unwind that we have up here. Lock that. There we go. And we have our liabilities situated. Here, there's no like assumption about any sort of dividend payments or anything like that. So our ending shareholders' equity is just going to be equal to our beginning plus any net income that we have during the period. And we can paste that over, paste over our equation, and there we go. Our balance sheet, it's obviously not balancing here because we're missing a few line items, but we did our necessary adjustments over here, and then we also kind of forecasted all the line items that we could. So now that we have our balance sheet situated, we're going to move on to the cash flow statement. Over here, I'll just delete these. We'll start with our net income. We're going to add back all our non-cash items. So typically it can be helpful if you can structure this the same way that things are listed on your balance sheet of DNA, then amort of intangibles, then PIK, then amort of financing fees. That'll be the easiest and fastest for us when we're pasting down our equations. So we'll add back our DNA, add back our amort of intangibles, add in our PIK interest, because remember that's non-cash. Also add back the amort of our financing fees. One thing that we have to keep in mind here is we have to less our DTL unwind. DTL unwind. That's important to not forget. In terms of kind of the working capital stuff, there's two ways you can do it. So the way that I prefer to do it is do it in the actual cash flow statement. You could also theoretically calculate like up here, put in a working capital line item and do it like that, but I much prefer to do it in the actual cash flow statement. So we'll do that. So the items that we're going to be looking at are going to be kind of all of our DSO or all our working capital. So we'll paste that over. And here we have to remember that for our assets, when calculating change in net working capital, we start with our beginning balance and we're subtracting out growth. So an increase in asset is going to be use of cash. So we'll paste that down for all three. We can kind of sense check this of, all right, prepaid expenses went up, which should be an outflow of cash. All right, negatives, that looks right. And then it'll be the opposite for our liability. So you start to take the current period minus the previous period, and so it's increasing by 1.5, and that should be a source, and that's being reflected correctly. So there we go. Now we'll go to kind of the upper line items. We'll start with our net income, which is going to be the bottom line of our income statement. DNA, we're just going to flip the sign from our income statement. So we'll do negative whatever the DNA was. And like I said, because I have my amort of intangibles listed directly below, just like it is here, that allows me to just paste over the equation directly. So I can just Control C, Control V, select over, and Control R all those. And so I can double check, but it looks like, yep, I'm adding back the amortization of my intangibles that was up there. So that looks correct. PIK interest and amort of financing fees, same thing because of the way that I listed them. It's PIK interest and then amort directly below. I don't like that. So this will be blank until I do my until I complete out the debt schedule, but looks correct generally. Then for the DTL unwind, it's going to be negative here. So we'll go back up to our goodwill calculation. We have our DTL unwind. We're going to lock it, paste that over, and now we have our cash flow from operations completed. So just like that. Alt HBC for that thick double border. Select it all down. There we go. Okay. Now that our cash flow statement is kind of completely situated, we'll go, or our cash flow from operations, we'll move on to cash flow from investing. So the only line item we're going to have here is going to be CapEx. And this is easy. Like I said, we're not doing a whole PP&E schedule. We're just having kind of a basic percentage of revenue, which is really nice because then I can go back up to my CapEx, percent CapEx as a percentage of revenue, take that and multiply it by my revenue. It's important that this is negative because this is a cash outflow. Paste that all over, and now we're on to cash flow from financing. And so for the model that we're building out today, it's going to assume a 100% cash sweep, meaning all of the excess cash beyond our minimum is going to be utilized to pay down debt as much as possible, with the exception of the PIK debt tranche, which we're going to assume just accrues PIK interest, which will increase the ending balance of the principal amount, and that won't be paid down. So the key outflows here are going to be for our revolver, term loan A, and our senior notes. Cash flow from financing. Financing. And so this will just be the sum of these three line items. There we go. Can paste this over, make sure it's right. And like I said, we're not going to be able to do these until we have our debt schedule completed, which is going to be our next step. So we're almost there. And then our last line item is just going to be our cash flow or net change in cash during the period. And you can format this a bunch of different ways. Typically, I'll just do it like this, with like a gray outline border, but it just depends. You just want to be consistent with how you're doing things. So this will just be the sum of our cash flow financing, investing, and then operations. There we go. Okay, now we're going to move on to our debt schedule. There's a bunch of different ways you can do it, but essentially they all get at the same thing. It's just looking at what your free cash flow available to service debt is. Available to service debt. And it's subtracting out your mandatory amortization. So these are mandatory principal repayments that you have to make, and this will typically be associated with your term loan A. So we'll have that. Then after that, we'll have our free cash flow able to service our revolver. And so the important reason you have the revolver after your mandatory amortization is if you have a negative kind of cash flow available to service debt, or it's not enough to cover your mandatory amortization, you're going to want to draw on the revolver, and so we'll model out kind of what that will look like, but that's why it's listed second. This will be less our revolver drawdown slash paydown, and the kind of formatting here where it's the paydown in parentheses is just showing that if it's being paid down, it'll be reflected as a negative, whereas it'll be a positive if it's like we're drawing on it. Next, we'll have our free cash flow able to service our term loan A. This is where we'll have our first optional prepayment, meaning that the term loan A will get paid down first before the senior notes. Then we'll have our free cash flow available to service our senior notes, and we'll take away any optional prepayment. I'll just paste this down. Optional prepayment to senior notes, with the end result being our net change in cash. Place this over, put a border here. Oh, just kind of paste these borders over. Okay, so we'll kind of format this out now. So our free cash flow that's available to service debt is really just our cash flow from investing plus our cash flow from operations. This is just kind of the excess cash that we've generated, excess cash flow, I guess, that we've generated that's going to be able to service our debt. We don't know what our mandatory amortization is going to be, but we'll paste this down. And then I can just paste this equation over like this. Boom. And then here as well. And there we go. So now we have everything situated and kind of laid out. The first thing that we're going to include at the top, and I typically like to do at the top, is our SOFR curve. So here we'll just assume that it'll stay the same. Actually, we'll assume that it grows by 25% each year. If you're not given assumptions about this, you can just grow it briefly, or you could even, if you want to, just keep it the same. It won't have like a material difference in terms of like the actual functioning of the model. It'll just change kind of some of the outputs. Now we're going to have our first like piece of the debt schedule, which is going to be our revolver. And so we're going to have our free cash flow able to service revolver. Let's bold this, and let's put in kind of a highlight here like that. We're going to start with our beginning balance. less our revolver, and I'll link it up here, less our revolver drawdown or paydown, our ending balance. Then we'll have our interest rate, interest expense, and for the revolver, it's not listed out, but we'll double because I think it's important. You're going to have sometimes unused commitment fee. So the way that you'll look at this is in terms of beginning availability, ending availability, ending availability. And so here, I think I didn't put it in the assumptions, but I think it was assumed that it would be able to be drawn on at 50 would be the maximum capacity for it. So we'll write it on 50, and the maximum capacity won't change. You can sometimes have where this will be priced off of like 75% AR plus inventory balance or something like that. It'll be based off of borrowing base, but for our case, we'll just assume that it's 50, and that's a hard-coded given assumption. So next, we'll start with our ending balance. So our ending balance in 2020 is just going to be from our sources and uses of what this is. Then our beginning balance is going to be rolled forward. So that's the way that all these debt schedules are going to work. Is your beginning balance is going to be equal to the ending balance in the previous period. So that's an important thing to note. Then for our free cash flow, we're going to link it up to what our free cash flow is that's available to service our revolver. And so this is kind of the core function of the LBO model that we're going to start working through. And so what you're going to do is for your paydown, you're going to take the negative min between your free cash flow that's available to service a specific tranche and its beginning balance. And essentially what this will do is it makes sure that your these not bolded. Oh, notice. It makes sure that you're not paying your debt down beyond zero. So let's say that we had 100 as a revolver balance. Here would say, okay, you have 100 outstanding for your or available to serve. You have $100 that you've already drawn on your revolver, which I guess is not even possible in this case. It's only 50, so we'll say 50, and you have 45 available. So the way the negative min will work is it'll say, all right, I'll take whatever less between my free cash flow and my ending balance to make sure that I don't pay down my debt below zero, and I use as much as possible. And so the reason this is important is, let's say that we had 100, we wouldn't want to just do this minus our 100, because what would end up happening is, it's actually fine if the numbers work out, but it shouldn't. Let's say we had 120, it would excessively pay down the debt. So we don't want that. What we want is this negative min, where regardless of what we have, it'll either pay down the entirety of the debt, but not below zero, or it'll just use as much cash as we're able to generate. Next thing, we got to calculate our interest rate. And so because these numbers for our SOFR are listed as like whole numbers is 200 instead of 2%, what you're going to want to do is select it and then do percent. And what that does is it'll essentially divide it by 100. So it makes it turn from 200 to, I'll show you in format as you can see. It'll equal 2%. So it's just 200, it's 2%, and I'll add to that my spread. So in this case, it's 400. I'm going to want to lock that, and I'll do percent again. And then it'll move over. So it'll be 225, which is 2.25% plus the 400. So that's kind of how you set that up if you have that as whole numbers. If you just have it as 2%, then you don't need to do it. You can just do it as normal. But if you're listing your SOFR out like this, that's how you do it. For your interest expense, it's important that you're taking the average of the beginning and ending balance because that's how it's been calculated. So it'll be your interest rate times the average beginning and ending balance. There we go. Okay, so now we have our interest rate and our interest expense situated. Next step is going to be to calculate our unused commitment fee as a percent, and then also as like the actual dollar amount. And so first you have to calculate your beginning availability. So the way to think about your beginning availability is just what's the difference between your total capacity, so 50, and your beginning balance. So what at the beginning of the period are you theoretically able to draw on is what your beginning availability will be, and your ending availability is just equal to your beginning less whatever more you've drawn on or whatever you've paid down. So let's say that we had 20 as our beginning, that would or 20 already drawn on it. That would mean that our beginning availability is going to be 30, and then our ending availability is going to be back up to 50 because in this case we have enough money to pay it down. And so that's just kind of how it works. And then for your unused commitment fee here, it's going to be typically it'll be like 0.25% or somewhere in that range. So we'll paste that over. Oh. And so then here for the unused commitment fee dollar amount, it'll just be this, the percentage times your average beginning and ending availability. And there we go. We have the first section of our debt schedule build out. Next, we're going to do our term loan A. And so the term loan A is a little bit more complicated because you have this mandatory amortization, but I'm just going to paste down the formatting first, kind of get this into place. I'll delete out all these numbers. There we go. And so we're going to have our free cash flow available to service our term loan A. We'll have our beginning balance less mandatory amort. And then we'll also have less our optional prepayment. And so the important thing to note is that until your TLA or your term loan A is paid down in entirety, you're going to have this mandatory amortization component that's always going to be there. So I'll go, you can do one of two things when you're linking these. After you do the first one, you can just look at it and know that it's one under. So like here, it's E30 for a revolver, but that means that underneath for the term loan A is just going to be E31. So what you can do is just do equals E31, or if you're concerned that you're going to mess it up, you can just go back through all the way up to your sources and uses, and then pick it directly from there. Okay, same as always. What's our beginning balance? It's just equal to whatever the ending balance was. So we're going to roll this forward. We'll link up our free cash flow available to service our term loan A, just like that. So for our mandatory amort, I'll just put in a basic thing. This isn't perfectly academic, but if this is greater than 0, take the beginning principal amount and multiply it by our mandatory amortization in each period, which will be 12.2. And so essentially what this says is just make sure that you don't put on any mandatory amortization if it's already been paid down, because you don't want it to be negative. But you'll have this in every period. And so here, same thing, negative min between your free cash flow that's able to service the debt, but you have to take into consideration the mandatory amortization. Because in theory, the maximum amount that you're going to be able to pay this down is not the 243 that's seen here. It's the sum of the 243 and whatever mandatory amortization you've already taken on. So you'll build it out just like that. There we go. And then I also have to build in this, just the ending balance. There we go. Oh, and I forgot to include here that do 0 if it's not. So there we go. So we can see that it'd be paid down in its entirety in, what year is this? 2024. But in reality, we haven't plugged in all our cash flow. It'll probably get paid down maybe in year 5. So we have to finish this out. For our interest rate, it's going to be the exact same as the revolver. So it'll be this percent, because I want it as a percentage, plus the spread, which is this 400, which I'll lock, percent. I got to paste it forward. You can see because they're priced the same, the interest rate between this and our revolver should be exactly the same. And then make sure that our interest expense is calculating correctly. Yep, it is. Now I can move on to the senior notes. So I'll copy down my formatting again. Alt-ST. Oh, copy down my formatting. Boom. And I'm selecting the whole row because otherwise it won't. So that's just Shift Spacebar to select the entire row, and that'll allow me to paste down the entirety of kind of the formatting from the debt service. Okay, for our senior notes, we're gonna have we're gonna have our beginning balance less our optional prepayment for the senior notes for our ending balance. So in this case, what we're gonna see is I'll pull it again. So this will be E32. That'll load in. Then I'll set our free cash flow table to equal senior notes up top. We're going to have our negative min. Looks good. It'll be taking the sum. Looks good. We just have to reflect the change in the interest rate. So for this, instead of being built off a spread, this is going to be fixed rate at 8%. So lock in that 8%. Make sure that it's calculating. There we go. So now we have almost the entirety of the debt stuff situated. Last thing that we have to do is do our PIK debt. So like I said earlier, PIK debt's a little bit more complicated because it's first non-cash. And then secondly, because it accrues that principal interest instead of kind of taking out an actual cash payment. So instead of subtracting a prepayment here, which we're not going to be able to, we're going to add our PIK interest. And so we'll have our ending balance. And then we'll have our interest rate. And so our ending balance here will be E33, so it equals E33. We can double check, but I think that's right. Yep, there we go, 81.3. Okay. Now for our interest rate, we're going to go link this up, because this will be important in calculating ending balance. It'll be 10%. Go in, copy over the formatting. Same as always. Beginning balance is the same as the ending balance from last period. The only difference is this is going to be a positive increase from the PIK interest. So I'll do the beginning balance times the PIK interest rate, and then I'll take the sum to get my ending balance. So that's how I'll get my ending balance. I'm going to just paste that over. But you can see that the principal amount is actually growing. So this is not cash that's leaving out. It's cash that you can put on your income statement for reducing your taxable income, but the actual cash payment isn't occurring. It's just getting accrued on the ending balance. And so the last thing that we can do here is we'll do our interest expense calculation. And so I'm just going to go back up here. It'll be our revolver, our term loan A, and our senior notes. And so this will be our total cash interest expense. And so it's important that you separate this out because you're going to be pasting it in to our income statement in different spots. Then we'll have our PIK interest, which is our non-cash, and then this will be our total interest expense. There we go. Starting with our revolver, starting 2020, our interest expense is going to be this interest expense plus our unused commitment fee. There we go. For our term loan A, it's going to be this 12. Oh, I think I put negative on accident. It'll be this 12. So you're just really linking everything at this point. Senior notes, going to be this 11.2. Total cash interest expense is just going to be the sum of those three. Then for a PIK interest, it's going to be pulled from up here. We listed it. Do that. We'll take the sum of these, and there we go. So our debt schedule is almost done. Now we just have to link back in our the payments. So we'll start with our mandatory amortization, which is the first. So we'll link that up here, which is our 12. Then we'll have a revolver drawdown and paydown, which we've already set up here. So equals there. Next step, we'll have our principal repayment or optional prepayment on our term loan, which we linked over here. And you can see that almost all the cash flow is going to be utilized to pay down our term loan A. But then in year 5, we actually pay it down in entirety, and so we have the ability to service our senior notes. And so we can see that every period we're paying down the entirety of our cash balance, and that's pretty typical in LBO models. And what you'll see is that the entirety of the cash is going to be utilized, or all the excess cash is going to be utilized to pay down debt. So now we're ready to insert back up top our cash interest and PIK interest expense. One key though is you're going to want to press Alt-TO. So Alt-TO, which will pull up the Excel options. Go to formulas, and you want to make sure that an iterative calculation is enabled. Otherwise, you'll have circularity problems where the model is just feeding into itself because the cash balance is being determined by the interest expense, which is being determined by how much you have outstanding on your debt. So everything kind of feeds back into itself. So you need to make sure that you have iterative calculation enabled. Then here, we're going to link to our cash interest expense, which is going to be all the way at the bottom here. So we'll have our cash interest expense, and then right underneath it's the PIK, so I can just paste this over. And you can look, as you scroll down, that our PIK interest is just right underneath it, so that's linking correctly. Then we can get rid of our highlight that we have here. Then for our cash, it's just going to be the beginning cash plus our net change in cash from all the way down here. There we go. For our property, plant, and equipment, it's going to be simple. It's the beginning PP&E less any DNA plus, I'm subtracting out a negative, any CapEx. And so because our DNA and our CapEx are the same, what you'll see is that the PP&E balance is going to stay the same throughout the period. Last thing we'll do is we'll link down to all of our outstanding debt balance, so revolver balance. Scroll all the way down to our term loan A balance, right there. Our senior notes, ending balance, and then lastly our PIK. And so if you've done this correctly, what you should see is that your balance sheet at the bottom should balance. So we did a good job. We can tell because our balance sheet's balancing, which is great. Not a single better feeling in the world than a balance sheet actually balancing. Last step for us is just going to be on our cash flow statement, linking in. This is a little bit excessive because it's already kind of being accounted for, but linking in all of our prepayment. So our revolver is 0. We have to remember to add both the mandatory amortization and the optional prepayment for the term loan. And then lastly, kind of the optional prepayment associated with the senior notes. Boom. We can see that our net change in cash is 0 as well, which looks good because our cash balance isn't changing. So that's like the core of the model. The last thing that we have to do here is we have to build out our returns analysis. So we're going to look at our LTM EBITDA. We are going to have our exit multiple, which is going to get us to our TEV at close. Highlight this. Then we're going to have less our debt plus any cash to get to our equity value, which is our EQV. EQV at close. And so this is the amount that we're going to have available for distribution. So we don't have anything funky like management options. We do have management rollover that we'll need to take into consideration, but we'll talk about that in just a second. So first, LTM EBITDA, we're just going to link all the way back up to our 2021, 89.4. paste that over. Our exit multiple is just going to be pulled from our assumptions, same as the entry multiple, and we'll lock this here because it's going to be the same moving across. I can copy over the formatting, so I have it as an X, and then our enterprise value is just going to be that exit multiple times whatever our EBITDA was. Next, for our debt, I'm going to do the negative sum because it's going to be subtracted out of all of our debt items on our balance sheet. So starting with our revolver, all the way down to our PIK debt, the negative sum of that, and then I'll add back any cash that we have outstanding. Balance sheet, go up to the cash. There we go, cash. Control R, move that over, and this will get us to our equity value at close. So it's important to note that because we have management rollover, meaning management has ownership of some of the equity value on our exit, we have to look at what percentage of this equity value is going to be attributable to them, and then what percent, I guess, essentially what's left over is attributable to us as a sponsor. So we'll look at our proceeds to management as a percent, and then we'll have our proceeds. Oh, popped up. Proceeds to us as the sponsor. So here we go. Sponsor. And then that's on a percentage basis, but what we really care about is what the proceeds are on a dollar basis. So we'll do this. I like to put a little border around this. Highlight it. Highlight it blue. That's what I've been doing. Highlight it in pink, so we'll do the pink. So first things first, the way that you look at this, and it's because the equity contribution here is just a percentage of the total equity, it's kind of already given to us, but you'll take the management percentage and you'll divide it by the total equity. And so what this represents is what percentage of the total equity does management own? And because in this case it was not like a percentage of the enterprise value they were rolling over, it was a percentage of the actual equity contribution, it'll be equal to that initial assumption that we have up. And so the excess, or essentially 1, if you think about it as like a whole pie, if management owns 10%, us as the sponsor owns everything else. So you'll do 1 minus the management rollover, and that'll get you to your like ownership or the proceeds that you'll receive. Paste these over. Last thing we'll do is we'll do the proceeds to management, and we'll multiply this by our equity value. So management in 2024 or 2021 exit situation gets 43, and we get 387. But this is like kind of overall what your proceeds are going to look like. The next things that we need to calculate is our MOIC and IRR. Just like this. Highlight it. B. So we're going to have our cash flows. The transaction date that was given to us, I believe, was 12/31/2020. We can use the EO month function to say start here and move forward 12 months or a year. Then we'll format all this. Oh, in the wrong spot. We'll format this as month, day, year. There we go. I like to italicize it. It's up to you. Your initial cash outflow that you're taking into consideration is just the sponsor contribution. So we'll go back up to our sources and uses. And so our sponsor equity is this 342, and that's happening at the end of 2020. So that's what you care about. And sometimes people like to format this as red and put a cash flow, like put a cash sign on it. We can do that. It's okay. Then for the proceeds we're receiving back, it's just going to be this 2025 dollar amount. So it's this 879. You can highlight this as green because it's a cash inflow. So our MOIC, IRR, highlight this over here. So for our MOIC, it's just going to be equals this divided by negative this, so 2.6. And then for those of you who know IRR approximations, this means that we're going to be having an IRR of roughly 20%. And so this is kind of the core of the model. This is really kind of where it ends. The last thing that you can do is look at sensitivity tables, sensitivity analysis. So the last thing that we'll do, and typically you'll see like, I don't know, you get a question and be like our hurdle rate, or like what's the MOIC and IRR on the investment, and let's say their hurdle rate was like 20% IRR and they need 2.5. This is like barely scraping above it, so like, kind of okay, but you can do this sensitivity analysis, look at it a little bit better. Last thing we'll do is our MOIC, we'll do our entry multiple, exit multiple. These are typically the most important things that you'll kind of be sensitizing. See, you can sensitize a few other things, but this will be one of the key things. I'll highlight this out, center this, alignment, center cross selection. Don't merge because it causes problems when you try and do selections. Just center it across instead of merging the cells. that causes problems. Formatting. Exit multiple, entry multiple, just like that. So we entered it 10 times. So let's just do minus 1 twice. I have to move this down. And then plus 1 twice. Then we can transpose this, Alt-S, transpose. We can run this a little bit further if we want, just so it looks good formatting wise. Then we'll format this. We actually have a formatting up here. Okay, then so we're looking at MOIC here, so we're going to link back to our MOIC in the top left. This is data tables, if you're not familiar. So you'll select the entirety of it, and you do Alt D2. So our row input cell is going to be the one moving left to right. So in this case, that'll be our exit multiple. So we'll go back up, we'll select our exit multiple. Our column input is going to be this entry multiple, which will be this one up here. Then I'll press enter. So then we get this resulting data table, which kind of format this really quick too. Which shows at if we entered at 9 times, or if we left it 9 times with an 8x entry, what would our MOIC be? So it just calculates across the table from like 10 to 10, which is what we actually had, which should be our answer, which is that 2.6 right there. And just kind of shows you that. You can do different things with this. You could do like a scale like this. You can set off to the side. You could be like, we need a hurdle rate of 2.5 times 2.5. Move this over, and then you could do like some conditional formatting of like highlight cell rules greater than this as green. Typically, I'll do custom format. Look at either the color or the fill. So just pick it up all the way down to the start green over here, just like that, like that. Okay, and then you could have anything that was less than this hurdle rate as custom. This red fill, you can do it like that. There's a bunch of stuff you can do here, but this is just like an example of what it could potentially look like. This is also pretty, like you wouldn't expect to see this big of multiple expansion. You wouldn't expect it to get up to 12. It's probably more useful to look at it just on the same basis. I just did that so it looked nicer. Last thing that we're going to do though is we're going to paste in this. We'll do our IRR sensitivity. Set this equal to this. One thing that I forgot is also typically in these tables, if you're doing it for an actual presentation, you'd select this and you change the formatting to semicolon, semicolon. What this does is it just hides it, so that way it wouldn't be included. But we have our MOIC linked, then I'll do the same thing, semicolon, semicolon, so it goes away. Our hurdle rate here, let's say it's 25%. Select the formatting. Oh, 25%. We're going to rerun the data table, so our exit multiple will be this row. Boom. Entry multiple will be there. And then we have to reconditionally format this. So highlight cell rules greater than this with this custom format. Fill green. Okay. Alt-HL. Highlight cell rules less than this custom format. This red. Boom. And there you go. So that's kind of it, broadly speaking, in terms of what it would look like. Just to go over kind of as a recap, everything that we did. Our steps were laying out the transaction assumptions, looking at kind of what our entry valuation was going to be, laying out our sources and uses, including some management rollover. Then we did our goodwill calculation, after which we did our income statement. We did our opening balance sheet. We made our necessary adjustments to get it in line with the capital structure looked like after the transaction was completed and the new financing was in place. We did our basic cash flow statement, looking at some of the key non-cash items like DNA, the amortization of intangibles that we had earlier, some of the PIK interests, and not forgetting our DTL unwind. Then for a debt schedule, we laid out kind of whether or not things were going to have the ability to be paid down, whether or not a revolver needed to be drawn on. Once we had our up and running full three-statement model with the debt schedule, we were then able to look at a returns analysis. In this case, we can see that we're expected to have an MOIC of 2.6 times with an IRR of 20.8, which depending on the firm is okay. Then the last thing we did was some sensitivity table analysis. I guess one more thing that we can do would be an operating case buildup. This is only if you have like a significant amount of time left. Build up. And so what this would look like would just be, say we'd have a case toggle, Alt-DL, Alt-DL to pull up a list so we can have our base case. Yeah, we'll call it base case, bull case, bear case. Did I put too much space in here? Oh. LTL. So let's say here that we had our base case, bull case, bear case. So there's a bunch of different ways you can do it. You can either do it line item by line item. Gosh. Just putting in formatting on this. So you can either do it line item by line item, where you had revenue growth, and then you'd have base, bull, and bear, or you can do kind of you just offset this, or you can do what I'm doing here, which is like a little bit more complicated of a build up using offset match. So we'll go all the way back up to our income statement, and the things that we'll sensitize will just be these four variables: revenue growth, SG&A, R&D, and gross profit. So I'm going to build this out for each one. So we'll do our base case, we'll do our bull case, and then we'll do our bear case. And so what we're going to do here is we're going to first have some sort of variation. So we'll have variation. And this is just going to be the difference between our base case and one of these other cases. So Alt HBT, bold it. So these will be our actual outputs. I think I actually need to move this over one. And so we'll start with our base case, which is just going to be all of the standard assumptions that we already had. So I'll go back up. This is 2020, so I need one more over, which will be this. Format these correctly, just like this. And like I said, this is something you'd only do if you had like a significant amount of time left, or for some reason you wanted an operating case build up. And so what you're going to do here, or the way that I would do it, is I just put a slight variation on everything. So let's say that the revenue was 2% higher, gross profit was 1.5% higher. For expenses, the benefit would be if they were lower. So I'll do minus 1% for both of those. Copy over the formatting. And I'll center these. And then for our bear case, it'll just be the opposite. So if we had 2% revenue net less, we had 1.5% less. So it's kind of just the opposites here. That's the formatting. Okay. And then in calculating this for what it would look like, let me also throw this on so I can see the years, so make sure we're correct. In calculating out what the bull case is going to be like, all you're going to do is this plus this number. Forward these. So assuming that the base case will stay exactly the same, your other cases will grow in accordance. And this is really basic. This isn't like a high quality buildup or anything. Select 1, 2, 3, H4 3 times. So that way it locks the assumption. Oh wait, I selected the wrong thing. It's supposed to be off of the base. There you go. Okay, so now you have your kind of assumptions laid out for what everything's going to be. It's important that I paste these as actual values so it doesn't get messed up. So now what I'm going to do is I'm going to do offset match to pull what the assumptions are depending based on what the toggle says. So here what I'll do is it'll be offset match. We'll start with our case, so our base case, and we want to select the entirety of this, so it's going to find it out of all of that. Exact. We're going to want to add to this a match for our revenue growth rate, looking up within each individual one, like that. Exact match. And then I subtract 1. Oh, wait, I need a... Sorry, reference. This needs to be 9. There we go. Minus 1. There. So what you'll see happens, it's a little bit of a complicated... Oh, wait, I locked the wrong thing. Oh, wait, I forgot to lock this. Okay, so what you can see here is with this formula, the way it'll work is it'll pull depending on where the toggle is saying different numbers. So if I switch it to the bear case, it'll input these new figures. If I switch it to the base case or the bull case, it'll be these upside numbers. And so actually, let's put in some of these. NM, not meaningful. Okay. And so the way this works is it'll just filter these numbers here, depending on which case is selected. And so honestly, so then I can link these back to the income statement. So let's go back to our income statement, revenue growth rate is going to be whatever is being outputted here. And then I can paste this over for these four. And so when I go down to look at my end results, my MOIC, my IRR, stuff like that, I can see that in my downside bear case, I'm at 1.8, 1.2. For my bull case, everything looks like a lot more green, and then back to my base case where I was operating originally. But this is like a basic buildup that you could do if you wanted to do like a case analysis. But yeah, I think that's everything in terms of, oh, and then also just for like last minute formatting stuff, you kind of want, if you have time and are able to go back and format some stuff, there's a few things that'd be good. So revenue we already did, but if you do F5, Alt S, O, just select constants, and then press X to unselect text, this will select every hard code that you have throughout the entirety of the model. And so these you typically want to have in blue, so you'll just do Alt HFC and then select that blue from earlier on. But yeah, I think broadly speaking, that's kind of the model. This. But yeah, you can have this like that. But this will be kind of, yeah, the base video. Thinking about maybe doing other LBO videos or I guess modeling stuff in general if people are interested. This is just kind of a basic full 3 statement build out. So I hope you enjoyed. Bye.